Hello everyone, welcome to week 6 lecture videos. We have 4 learning objectives today, and as usual I will be uploading 4 separate videos on these learning objectives. So this is learning objective 1. In this learning objective, we discuss smart beta investing and examine the justification for using this approach as opposed to the approach that theory would suggest, which is the Markowitz portfolio selection model. We have previously seen that if we apply Harry Markowitz's portfolio selection model, we should come up with an optimum portfolio by simply looking at the expected returns and the variance-covariance matrix between stocks. In this particular case, when we apply Markowitz's portfolio selection, we are looking at expected returns through the CAPM, and we are assuming that expected returns can be explained by that single factor, which is systematic risk or beta. However, there is a whole lot of assumptions underlying the CAPM, and some of them could be problematic. So we have already looked at the fact that while the CAPM is underpinned by the assumptions related to mean variance utility, there are a range of other utility functions that might better represent investor preferences. There is also a whole lot of empirical evidence that demonstrates to us that beta alone is not able to explain returns. So if that's the case, there could potentially be scope for investors to earn abnormal returns by looking outside Markowitz portfolio selection and adopting alternative approaches. One potential approach is active investing. And active investing is basically stock picking, where investors look at trying to select those stocks so they are going to have outperform market using a range of different tools and forms of analysis. However, as we previously discussed, that evidence suggests that active fund managers, after considering transaction costs, actually underperform the market. So maybe active investing is not an ideal alternative. More recently, attention's been focused on a new paradigm in investing that takes the best use of both worlds, from Markowitz portfolio selection and active investing. So what's that? That is smart beta investing. Smart beta investing is a process where we extend upon Markowitz portfolio selection in terms of using empirical evidence to come up with improved models of expected returns above and beyond the CAPM, and then feed those into the process of coming up with a superior optimal risky portfolio. Within smart beta investment strategy, it's important to note that it's a passive strategy. It's passive in the sense that it adopts a systematic approach. That means that there is an algorithm that is put in place to dictate which stocks to buy and which stocks to sell. And that algorithm will be based on some screen that is related to the investment philosophy of a particular investor who is managing the portfolio. However, rather than simply just tracking the market index, a smart beta portfolio is designed to track non-traditional risk factors, and therein lies the value in terms of the portfolio manager. It's about trying to identify which of these factors are going to be relevant. Now, when selecting these factors, investors need to look at a number of different issues. First of all, investors should consider their own views on how markets work and whether or not markets fail, and where they may fail, and use that particular smart beta factors that might take advantage of potential failings or mispricings. Equally, there should be a scientific approach to smart beta investing that uses both previous empirical evidence, so academic studies are a key source here, but also portfolio managers undertake their own back testing to test the effectiveness of their trading strategies before simply diving into adding some smart beta factor into their models. There is a range of different factors that have been proposed, and these factors form the basis of a number of different funds that are managed by institutional investors around the world. 5 of the most commonly used smart beta factors are momentum, value, growth, low volatility, and quality. So why do we need to go for a smart beta investing, why we can't simply invest in a benchmark or in the aggregate market portfolio. So there may be some merit in considering the idea of smart beta investing rather than simply just holding a passive market portfolio. Well, there is a line of critics of market indexing, I mean, investing in a market index. First of all, there is an over allocation to large cap stocks. Okay? Consider this to be particularly in a country like Australia. As I previously discussed, that in Australia, the 10 largest listed stocks comprises about 50% of the total market capitalization of the Australian equity market. So despite the fact that there is over 2,000 stocks listed on the Australian market, half the market capitalization is concentrating in just those 10 stocks. Therefore, if you are holding the market portfolio with market cap weightings, 50% of your portfolio is going to be just those 10 stocks. So it could be argued that there is some overexposure to those really big companies. And also it's important to note that benchmarks themselves can be inherently risky. While holding the market benchmark is the ideal investment strategy for investors who believe that markets are perfectly efficient, if investors' philosophy was that there is some inefficiency or market failing in any subset of the market, then the market portfolio will actually serve to overweight overpriced stocks and won't actually be the ideal investment for that particular investor. We can give an example of that in the next slide. I suppose for simplicity that there is only two companies. Suppose that both companies have 10 million shares on issue. And let's assume there was some way that we are actually able to observe the intrinsic value of each of those stocks. So the intrinsic value of each of these two companies is $10 million. But suppose that markets are less than perfectly efficient. That means there may be underpricing or overpricing. So, well, in that particular case, let's say that there is a mispricing in company's S stock. Its intrinsic value is $1 per share. However, market value is $1.2. In the case of company B, its intrinsic value is $1 and it's slightly underpriced. Its market price is 80 cents per share. Now, in this particular case, if we would market weight our portfolio, what we would do? What we would do is we would weight them according to their relative market capitalization. So in this simple example where our market is just two stocks, the total market capitalization will be 20 million. So in that case, we would have 12 over 20 million or 60% investment goes to company A, and we would have 8 over 20 million, so we would have 40% investment in company B. So what's the implication of this example? The implication is we are actually overweighting the stock that is overpriced. So we are investing more heavily in the overpriced stock than what we should if we are to apply some measure of fundamental weightings. And we are underweighting the underpriced stock. And this is always be the case when we adopt market cap weightings. So if there is any form of inefficiency in the market, this is where market weightings can really break down. So one point here is that passive investors are assuming markets are relatively efficient or assuming that market prices are the best available measure of firm value. There is also some other potential issues with using market indexing. Some people who believe in active investing would say that market indexing does not make the best use of portfolio manager skills. But also the fact that you are not able to benefit from some of the evidence that has been put forward that shows that there are these additional smart beta factors that can explain returns, or the fact that returns can be explained by more than just systematic risk. And if we are able to come up with improved models of expected returns, then we can actually improve our portfolio selection. So what we are looking in terms of smart beta investing is what we would consider to be the holy grail. So we have put our benchmark performance here, which is the performance that would be generated if they just held market portfolio. But the holy grail is to think we can we actually perform better? Can we increase our Sharpe ratio? Or can we do that by either potentially adding a layer of additional performance through smart beta, practice, and that is by measuring our expected returns with these multi-factors on CAPM by adding these additional factors into our estimation of expected returns. Or potentially, can we generate pure alpha, which is here? This is through active investing, using the ideas of active stock picking to try to increase overall performance. Now, so you can see that fund performance can be higher than benchmark performance either by smart beta investing or by earning a pure alpha by active management. Now, there is a whole lot of empirical evidence that says that this red box may not be much better today, as evidence shows that active fund managers actually don't tend to outperform the market. However, there is a whole lot of empirical evidence that shows that the second box here does have some merit. So we can use a smart beta as a way of improving our performance of our investment portfolio. So that's the end of our discussion on learning objective 1. Please watch the next video for our discussion on learning objective 2. Thank you very much.